Hi, everyone. Cooper Simmerman here, the Director of Communications for Centurion Wealth, and welcome to Centurion's quarterly video series. Once a quarter, we're going to take a deep dive into a financial planning subject, interview a professional from the financial services world, or otherwise bring you content that hopefully educates and informs you. For this session, I hosted Rebecca Corbin of Corbin Advisors for a look into their latest Inside the Buy-Side Earnings Primer. Rebecca is a renowned investor relations strategist, a speaker, and a market research analyst. Rebecca often appears on CNBC's Squawk on the Street and even has spoken at the World Economic Forum in Davos. This conversation is full of quality research, insights into what management at large corporations are thinking, and professional opinions from Rebecca. And after you listen to Rebecca's presentation and the accompanied slide deck, stick around towards the end of the video for some question and answers that address some of the relevant topics in today's market. Thank you all for joining us, and let's get started. All right, everybody, welcome Rebecca. Thanks for joining today.
Thanks, Cooper. It's great to be here.
Thank you for jumping on. So you are the CEO and founder of something called Corbin Advisors, and you recently, last year, celebrated your 15-year anniversary. So congratulations on that, first of all. Is that hard to believe? And maybe what sort of emotions does that kind of bring about when you hear the 15-year anniversary of Corbin Advisors?
It is definitely exciting and hard to believe that I have run this company with a great team, by the way, for 15 years and also been in capital markets for 23. And just a passion of mine and just an exciting time in our evolution as a research and advisory firm that consults publicly traded companies pre-IPO all the way up to 360 billion in market cap across all sectors.
If you don't care for our audience, take me back to maybe that 15 years ago, and what were some of those motivations? Like, why did you feel like what was missing in the market, and why did you found the firm?
Absolutely. I started my career at a company called Thomson Reuters, and there I was a stock surveillance analyst, and I was tracking institutional money flows for publicly traded companies, specifically for media and entertainment companies. And I worked with a very large, well-known media and entertainment company who was going through a contested proxy battle where shareholders wanted to separate the CEO's role as CEO and chairman. It was a combined role. And they felt that this particular CEO had too much power being the chairman of the board and also running the company as a CEO. And so I conducted voice of investor research. I've trademarked that now, but that's what I was doing. And I got a sense of what shareholders were thinking and what their concerns were and how they were going to vote in this proxy contest. And I worked with that client to help them in their roadshow as they were meeting with shareholders and steward groups. And they won that proxy contest. And I realized that I had a real deep passion for interviewing and understanding the voice of investor. And these are large institutional investors. So not so much the retail folks, but investors that would be at Fidelity or Wellington, Norges Capital Research. And so I actually started that business for Thomson in my early 20s. And then in 2007, I hung my own shingle, and probably the most challenging time to start what we call perception business, because it was at the foothills of the great financial crisis.
Sure.
But actually, that's why I'm here with you today, because to reinvent myself, since it was very difficult to obtain clients, I created our flagship research called Inside the Buy Side, and I would conduct interviews every quarter with institutional investors to get a better understanding of how they were thinking about companies, the economy, and what companies really needed to do to manage and navigate through that very difficult time period, really between 2008 and 16, 17, when we finally started to get some traction.
Well, you kind of picked the best time to start it, I would imagine, then, like a communication firm talking about the issues in the middle of a recession crisis. It's kind of the best time to launch in retrospect.
It did work out well.
Yeah. Well, that leads us to our format today. So folks, for listening, jump over and watch the YouTube part of this. But if you're on YouTube, the format is going to be, we're actually going to go through the Corbin Advisors Q4 2022 Inside the Buy Side Earnings Primer. And then after that, if we do have some questions, I've been reading all through it over the last couple of days, and I've got a couple of questions that I want to ask you, and we'll go through it there. So without further ado, Rebecca, I'm going to toss it over to you, and we're going to go through the Inside the Buy Side.
Absolutely. And just by way of background, We publish our Inside the Buy-Side Earnings Primer and Inside the Buy-Side Industrial Sentiment Survey every quarter. We publish it heading into the earnings season. So typically in that first quarter, that first month, it's the second and third weeks that we're publishing. And it is available on our website at corbinadvisors.com. And we are surveying institutional investors globally to get a real benchmark with regard to a baseline, if you will, with regard to how they're thinking about the quarter, what their expectations are for earnings, and also what they're expecting to hear from management and their views around the economy. So it's a really great barometer for management teams to really understand what the perception is out there. And it's not necessarily reality, it's perception. But if we're thinking about our performance in the context of investor sentiment, we have to be aware of landmines and also where we might see appreciation because they're over-rotated on certain themes. So I'm going to share my screen here. Okay, and I'm going to take you through our Inside the Buy Side. Just to baseline everybody, we conducted 80 surveys, 80 participants globally, much more focused on the buy side or the institutional investor side, but we also include about 30% sell side analysts, those analysts that are publishing research on companies. The equity assets under management total 3.8 trillion. So these are very large organizations. And this survey ran really mid-December to early January, just to put a timestamp on that in terms of the findings. So net, investors are expecting a challenging 2023. We saw that the draconian views that occurred in the third quarter have softened somewhat, and I'll get into that a little bit. But that management tone is now more downbeat than the bearishness that we see from investors. So you can see the word clouds. Every quarter, we're publishing a synopsis of the sentiment. And as you can see in the fourth quarter of 21, it was still fairly positive, downbeat, but there were some green shoots around demand and earnings and bullishness around the economy to some extent, and then growth. And as we headed into the first quarter of 2022 and throughout, after 4 consecutive quarters of increasingly bullish sentiment that really occurred mid-20 through 21, we saw a major shift in bearishness come into the picture. And 22 really has been the height of that bearishness, culminating with the most bearish sentiment that we've seen in the third quarter. So the third quarter 2022 was commensurate with the onset of the pandemic, as well as the 14 through 16 recession, the mini recession that we went through. The only positive is that investors at that time were thinking that the recession would be shallow. But as you can see, inflation, interest rates, recession, all top of mind. Heading into this survey, the fourth quarter survey, still downbeat, but as we'll see, not as downbeat as we have seen last quarter. And so that's a good place to be in terms of they're typically, as I show on this slide, about 2 quarters in advance of where corporations are. So as I mentioned, in September of 21, that kind of third quarter period, we really saw reversals when we started to see pretty significant bearishness coming into play. You do not see that in the management tone. Management tone wasn't until really June of 22 where we started to see pre-announcements. We started to see messaging around conservativeness, downturn playbooks, and slowing growth communication. And that would continue. And now we have actually an inflection point where the management teams are more bearish than investor sentiment. So we have a really nice inflection point setting up 23 for conservative guides, which is what we want. We want companies to come out and take into consideration that there is slowing growth, that there is the likelihood of a recession, and that there are things that we can't account for with what we know today. And we want to build in enough hedge. And the street is giving us that get out of jail free card to be conservative. And if we are conservative enough, we can see a year, as long as things don't get worse than expected, where we underpromise right now and we over-deliver in quarters to come, which will obviously help the stock market because there's a healthy amount of market psychology built in, and expectations management is really the X factor. Very quickly with regard to full year expectations for 2022, and specifically the fourth quarter, generally expecting worse than performance across organic growth, margins, EPS, and free cash flow. Now, again, This is investors' expectations heading into earnings season. And the same thing with regard to guidance. They are generally looking for lower 2023 guidance relative to what performance is in 22. So that's baked into the market. When we think about capital allocation, which is one of the critical components of investments, there are actually 5 core critical components that we've identified through over 20,000 interviews with institutional investors and analysts. And those 5 components, which we call the Corbin Critical 5, number 1 is leadership. Number 2 is long-term strategy. Number 3 is execution track record. Number 4 is competitive advantages. And number 5 is capital allocation. This is what investors are looking for companies and telling us that these are the most compelling elements when they are making an investment decision. As you can see, where we started with the pandemic, which has really started this cycle that we're in, and where we are now is almost mirrored with regard to where their capital allocation preferences are. So they're focused on debt pay down, conserving cash. These are companies, they're encouraging companies to pay down their debt, and generally they're looking for a sub-2 net debt to EBITDA. Conserve cash. Let us take the opportunity when there's dislocation in the market. Reinvestment is third. That has been number 1 for a consistent period of time. M&A, buybacks, and dividend growth are pretty low rated. So you can see that there's a lot of opportunity in terms of capital deployment. And drilling down a little bit further, the reinvestment piece is, and this gives us confidence, while they are communicating that companies should be conserving cash, should be paying down debt, should be cost cutting, and really hunkering down for what they believe we're going into a recessionary period, they still are saying not at the expense of future growth. We still want you to reinvest in your company strategically. And as you can see, in terms of those encouraging companies to maintain or increase CapEx has increased almost 60%. Views on buybacks are more downbeat. Buybacks were at the height in 21 and 22. We are now seeing that the majority of investors are recommending that companies moderate or cease buybacks. Again, not the best use of cash in this type of environment, even though we have really low share prices. So there's a bit of a push and pull in that regard. When we ask them about China and Europe, and specifically companies that have business and operational exposure, China risk still remains very high. 73% are ascribing a high level of risk to companies within their portfolio that have this exposure and or are screening them out. And that is going to be an overhang for a while. It does not necessarily mean it's systemic, but now in this period of time and for likely several more quarters, that will serve as an overhang for companies that have China exposure. Europe actually is seeing a bit of a warming. It's not as bad as we've seen it. And also we've had a very mild winter. I will say though, that clients that we work with that are exposed to China and Europe in my channel checks recently are saying that they are seeing an improvement. So this is an area where we may find that the financial community globally is a little bit more over-rotated on the negatives and may be pleasantly surprised by the performances of companies with exposure to China and Europe. Top concerns are consistent: monetary policy, inflation, geopolitics and war, Ukraine and its persistence, recession, labor, and the US administration in terms of what we're doing around interest rates. And then, of course, when we think about, are we going into a recession? The financial community believes that we are. 61% suggests that it will happen in the first half, and almost 20% say we're currently in one. And of course, we are at a point in time where there are a lot of sectors going through different cycles right now. When we were in the pandemic, all sectors were going through the same situation, and we're performing very similarly outside of the most hard-hit transportation, et cetera. Now we have a lot of different cycles going on, but generally the expectation is that we will see a recession. And when we are in a recession, it is expected that companies would cost cut, that they would do CapEx reductions, and that they would do layoffs. And as we know, we're seeing all of this right now. Consumer products, technology companies are announcing massive layoffs to the tune of 10%. And that's what we call the quiet killer, because that's happening and there's a lag with regard to employees getting laid off and absorbed into the system. We obviously have a very still tight labor market, but the trends aren't moving in the right direction for us. And for all of the companies that are publicly announcing their layoffs, there's probably a whole plethora of companies that are not announcing that, but still going through those actions. So that to us is a big red flag. In terms of equity valuations, professional investors believe that equities will contract this year for the US, and they are looking at a weaker first half, stronger second half. So just by the math, the first half is going to be very difficult. We have very difficult comps for companies 2022 versus 23, but as we get through that and into the back half, the comps tend to ease because that's when the slowing growth began. So mathematically, we will likely see a stronger back half, not necessarily strong, but stronger relative to the first half. And then finally, I want to end our research on the sectors and the sentiment around the sectors. So we see healthcare, financials, and within healthcare, biotechs also are seeing a resurgence after, quite frankly, being on life support for several years now. They've been completely out of favor. They're starting to get some positive favoring from investors. And building products, things tied to the housing market, completely out of favor. And so this just gives you some perspective with regard to how professional investors are looking at the sectors. I want to highlight also technology. And why is technology out of favor? Well, all of these companies that have been going through this slowing growth cycle have a lot of CapEx, and they've been investing in technology, digitization, automation, et cetera, and they're pulling back on that. So technology is a benefactor when things are great. They're always a great sector, but they're feeling the pressure of corporations really tightening their belts in this slowing growth environment.
I will make this, again, if you're listening, I will make the link available to the full report with the PDF version in the comments below. If you're on YouTube or if you're on our website, check it out. It's right there in the comment section. But Rebecca, while I have you, I do want to ask some questions that our job as financial advisors, we communicate with clients, daily, right? We're trying to, they're sharing their needs, goals, objectives, fears, and concerns, and we're trying to apply that with their financial plan. And something that I think you mentioned on the first couple of slides with recession appearing throughout the word chart there, the word recession just triggers a lot of anxiety in folks, right? And I want to hear your opinion on, well, first of all, there's this analogy that I like that if you think of the stock market and the economy as like an individual walking a dog through a park, right? They're both generally going in the same direction, but sometimes the dog is going to the left of the park, to the right, on the right side of the sidewalk, and the person is following behind them. Kind of, not a perfect analogy of the stock market and the economy. Sometimes there's a timing issue, and sometimes they're not pointed in the same direction. So when folks say recession, and we hear management saying that we still could be entering a recession, doesn't necessarily mean that the stock market continue to slide. That could just mean we see more macro conditions play out or more layoff, but the market is a forward-looking indicator. Maybe that's already priced in, and it actually could start to rise even though we're entering the recession. Does that make sense? And how would you maybe best explain it to someone hearing that on the news and seeing it and trying to make sense of it all?
Absolutely, it makes sense to me. So the market and the macro are inextricably linked right now. They're in lockstep, and they've been really since the pandemic. Although we saw during the pandemic the ability to provide greater level of transparency, even though companies rescinded guidance and said we can't give annual guidance, we can't even give quarterly guidance. What they gave was a greater level of transparency with regard to monthly sales and scenario analyses. And as they called for the second quarter being the nadir of performance and saying things like it's going to be down 60 to 70%, and it was down in the second quarter, but only down around 30 to 40% in terms of performances, the market reacted very favorably, even though the pandemic was still at large. And we saw that market in the back half of 2020 really start to climb based on the expectations management. we're seeing that now too. It's been in this kind of super cycle, right? All these companies are hitting all-time highs, record backlog, record revenue, and we're going into a multi-sector cycle, down cycle, right? So not all companies are being hindered by this. There are some real great secular tailwinds, like in the infrastructure bill, et cetera. But our view is that the market and the macro have been inextricably linked. We are about to get a dose of 2023 guidance. And the reason why the macro and the market have been linked is because of the uncertainty. What we thought 2022 would look like did not pan out. And a lot of uncertainty was injected in the market in terms of what is downshifting now and what is not. And so now we have all of these different performances happening amid companies, and investors can't make heads and tails of it. They will be able to get a dose of information as we go through this earnings season, and they will be able to see where organic growth, earnings, and cash flow is going to settle out, and then they'll make their bets. So we believe there's likely to be one more capitulation as the analysts on the sell side and the buy side recalibrate their models for the guidance that's provided from companies. But then we do believe there is going to be a breakout where companies will be able to decouple performance from the market because they've set expectations at the right level and they're able to underpromise and overdeliver. Now, that is assuming that we don't get materially worse than what we're seeing right now. But as you pointed out, investors have been talking about recession for 3 or 4 surveys now. It's baked into the market. That was the performance that we saw. And again, there may be one more capitulation in the market, but they're moving on.
The market can handle good news. It can handle bad news. It does
Absolutely.
not like uncertainty is what it doesn't like. What about, okay, so how should retail investors process what management at big corporations are saying? Like your report walked through some of this expectations, and they have tremendous insight because they lead global companies and they can see kind of into the future, if you will. No true crystal ball, but they have tremendous insight that maybe a retail investor doesn't have. But how should, in your opinion, the average retail investor kind of process what they're saying into what they're looking at with their investments?
Well, right now it's a stock picker's market. It is a stock picker's market. There are certain sectors that are less challenged right now, but there are also sectors that are completely bruised and broken that are tremendous value plays that can be great investments if you've got a time horizon to invest in companies that have been battered but are very strong, long time, durable companies, right? So I always look at the company itself, right? Right now, large caps, North America, those are all favorable themes. In an economy that's going down, you want to be with a company, you want to invest in companies that have been cycle tested, have strong leadership teams, have very strong balance sheets, low debt levels, good cash flow, that is going to have the opportunity to, manage the storm, work through it. They have a downturn playbook, they've played it before, and be able to come out on top. Smaller cap companies, technology companies, companies that have new management teams, newly minted management teams like SPACs and others, they're going to be challenged to understand how do you navigate through this type of an environment. So go with the trusted, durable companies that have been around for a long time and look for deals, because if you've got a good time horizon, as I've been telling our clients, and our clients are CEOs and CFOs that, are very concerned about their share price because they are, beholden to the shareholders. There's a lot of designer stocks on sale right now, and we don't often get to see designer stocks on sale.
And I will just say, as our compliance department always likes to point out, that these are opinions, these are for educational purposes only, not recommendations. So folks, work with an advisor, work with a professional. Rebecca, thank you for that insight. Another question, if you'll bear with me here, is if we zoom out, like look at the market, not in terms of quarterly, like look at it in 5, 10, 15-year chunks. Like, is it easy to say, or does it make sense to say that you could draw a straight line from artificially low interest rates for a decade coming out of the Great Recession when you founded Corbin Advisors back in 07, 09, or 2010. And then for a decade, we quote unquote had largely cheap money in the market. And then what we saw is one of the biggest bull runs we've seen from 2010 on through, recently a couple of years ago. Is it easy to say that those artificially low interest rates kind of directly led to the asset increase prices? And now maybe that those days are like, are we ever going to see a 2.6% mortgage ever again? Like maybe, maybe not. But like, is it fair to say that those low interest rates kind of led to this? And this could be almost, hindsight's 2020, but could almost be expected now that, I mean, it's even like a kind of like a meme that like venture capital firms are looking for companies that now produce revenue. Like it used to just be like money was just getting thrown around into any company. Now it's like, well, you actually have to be producing revenue now. Like, does that make sense to you? And is that fair and accurate to say, in your opinion?
Well, it's still cheap. So, it's not, yes, we're raising rates, but it was artificially low to begin with. And I'm not going to say that the reason why we've had this bull run is only because of cheap money. I think there's been a lot of factors. There's been companies that lived through the financial crisis with bloated balance sheets that just got their debt levels really low, started to really focus on the fundamentals of delivering revenue, cash flow, margin, and we're a lot smarter. I mean, if you think about it, in 2008, that's when the smartphone came out. Just the sheer level of information available. And in my experience in capital markets, prior to the great financial crisis, institutional investors were not focused on macro data. It was a much more of a bottom-up analysis that they were doing. And so everybody now is attuned and intelligent on the macro and following it real time. So that has created just, I believe, much smarter, much stronger organizations. And that's why I'm not too concerned around a recession, because these companies are tremendously stronger than they were, 10 or 15 years ago. A lot of lessons have been learned. And we saw that through the pandemic. Companies have been dealing with crisis for a long time. China tariffs, the pandemic, the mini recession, the great financial crisis. This is still in our purview of learning. So, I think there's a lot of factors that led to this bull market. We were in an overhang. We had a hangover from the great financial crisis for a long, long time, until really the pandemic.
It is true. This is like it's a new era. It's the information age, like real time, information at the fingertips, like even things like on social media, right as they come out. That really didn't exist in 2008, 7, So good points there. Last question for you is, do you think in management and investors, are there lessons to be had now going through COVID when we saw them respond so swiftly and, at a scale unprecedented with stimulus money getting pumped into the economy and, if like literally Americans got checks in the mail, like stimulus, and then just big, like the PPE, like, do you think management are we studying that? And then is that in any way maybe factoring into, if there's a future crisis, what the government's going to be willing to do and how they message around that maybe in the future? Is there any kind of insight on that?
Not necessarily from what we're seeing at our corporations. Obviously, the labor market is a big factor. And that has the stimulus, the PPE, the fact that we really, because of the sheer level of demand that was required, companies were willing to pay employees at any cost to be able to fulfill that demand for their customers. And now that's coming down. So I do think that, we were probably too far one side before the pandemic, and then we swung too far to the other side, and we have to settle out and really get that balance. But, they're focused on, obviously, the interest rates are probably much more a focus. The cost and inflation, to the tune of generally 10 to 13% increases that we're seeing at our clients year over year in terms of, just nothing changes outside of inflation. So they're dealing with a tremendous amount of, challenges. And of course, we have a slowing demand. So some of that will work its way out of the system just naturally. I do believe that we've just learned a tremendous amount, and labor, productivity, and the difference in this environment than maybe even 5 or 7 years ago is that there is this new economy that's sprouting. There's the energy transition, there's ESG, which we focused a tremendous amount of our time on ESG. We have an entire practice dedicated to it. And companies are embracing this new way, this more sustainable way. It is not a fad. It is a trend. It is a long-term trend. And according to Bloomberg, $53 trillion of assets under management will come into play in the next 5 years that will be dedicated and focused on finding companies that are embracing how to be a more sustainable steward of capital.
Wow. Yeah, that's no small chunk of change. Look, Rebecca Corbin Advisors, I will, again, guys, if you're listening, I will link the full report so you can comb through this. Thank you for coming on and sharing your insights, your point of view, and your professional take on this stuff. It was tremendously helpful. Thank you for coming on.
Thank you, Cooper. It was great to be here.